By the end of this course, you will learn how small losses are manageable, but larger drawdowns require exponential recovery efforts. Learn how to implement strategies like stop losses, position reversals, and hedging to minimize trading risks effectively. Learn methods like dollar cost averaging and pyramiding to balance risk and maximize profitability. Learn how to manage risk strategically and navigate market complexities for consistent, sustainable trading success. In trading, managing losses is just as critical as making gains. The recovery table highlights the mathematical relationship between the percentage of loss and the corresponding percentage required to recover. The numbers are straightforward but eye-opening. For instance, a 20% loss demands a 25% recovery. A 40% loss requires a 66.7% gain, and a 60% loss? You're staring at a 150% uphill battle. This table illustrates an important truth: the deeper the loss, the exponentially harder it becomes to recover. The relationship between loss and recovery isn't linear. Small losses are manageable, but larger drawdowns become increasingly challenging to reverse. This is why disciplined risk management is essential. Limiting your position sizes, using stop losses effectively, and maintaining consistent risk practices are critical to avoiding significant drawdowns. Large losses not only deplete your capital but also impact your ability to trade effectively and recover in a reasonable time frame. The recovery table underscores the importance of protecting your account. Avoiding substantial losses isn't just about preserving capital, it's about ensuring your long-term ability to stay in the market and capitalize on future opportunities. By understanding the recovery table and implementing disciplined trading practices, you position yourself for sustainable success. The key takeaway is simple: avoid significant drawdowns, and you'll never have to face the grueling climb of large recoveries. In trading, no strategy is foolproof, and losses are an inevitable part of the process. However, with a solid set of risk mitigation techniques, you can minimize the impact of losses and maintain control over your trading journey. Let's break down some essential methods every disciplined trader should master. Every trade should start with a clearly defined stop-loss level. This isn't just a number on your screen, it's your line in the sand, a predetermined point where you accept a small loss to avoid a catastrophic one. Cutting losses early prevents you from falling into the emotional trap of holding onto a losing position, hoping it will turn around. Instead of reacting emotionally, you act decisively, protecting your account and preserving your ability to trade another day. Sometimes, the market proves you wrong, but that doesn't mean you can't adapt. Cutting your losses and reversing your position can be a powerful tool when the conditions are right. For example, if your initial trade was long, but the market breaks through key support levels, a well-timed reversal to a short position could capitalize on the emerging trend. This technique requires a strong rationale and clear confirmation signals. It's not about guessing, but about adapting to what the market is telling you. Hedging involves opening an opposite position to offset risk. This approach is especially useful during periods of high market volatility or when you want to lock in profits or minimize your loss while keeping your exposure to the markets. For example, if your long position moves into a loss, opening a short position locks in the loss and prevents further damage. This hedge offsets the risk, allowing you to either close one side when the trend becomes clear. Hedging isn't about making a profit on both sides, it's about reducing the impact of uncertainty. Hedge reverse is the process which involves unwinding your hedge by adding another position to the dominant direction. For instance, with the example earlier, if your initial trade was a long position that moved into a loss as the market turned bearish, you might have placed a hedge by opening a short position to offset the loss. Once the bearish trend becomes apparent, initiate a new short position to align with the trend. This approach allows you to transition from a defensive stance into an offensive one, turning a challenging situation into a potential profit opportunity. The key is to act decisively and only when strong signals confirm the market's new direction. Hesitation or premature action can result in unnecessary losses or missed opportunities. Scaling techniques are strategic approaches to adjusting your position size in the market. When done correctly, they allow traders to optimize their entries and maximize their profits while managing risk effectively. Let's explore two popular scaling methods: dollar cost averaging or DCA, and pyramiding. Dollar cost averaging involves adding to a losing position in smaller increments, effectively averaging out the entry price. This technique assumes that the market will eventually recover, making it suitable for long-term investing in assets with a strong fundamental outlook, such as stocks or cryptocurrencies. For example, if you buy a stock at $100 and the price drops to $90, you might add another unit at $90, lowering your average cost to $95. If the price recovers, your position becomes profitable faster than if you held the original entry. However, DCA isn't without risks. In short-term trading or volatile markets, adding to a losing position can compound losses if the trend continues against you. Use DCA only when there's a solid reason to believe in a market recovery, and always have a maximum allocation limit to avoid overexposure. Pyramiding is the practice of starting with a small initial position and adding progressively larger positions as the trade moves against you. This approach aims to improve your average entry price, allowing for a quicker recovery if the market reverses. For instance, if you enter a small sell position and the price move against your direction, you add another larger sell position and add an even larger position again. This method assumes that the market will eventually reverse, enabling you to exit at a smaller loss or break even. While this strategy can be effective in recovering from unfavorable moves, it significantly increases risk. If the trend continues against you, losses can escalate quickly. Use this technique cautiously, with strict risk limits and clear exit strategies to avoid excessive exposure. In trading, position size isn't just about how much you trade, it's about how much risk you're willing to take. Properly sizing your positions is one of the most critical elements of risk management, and it starts with understanding the widely used 2% risk per trade rule. The 2% rule means you never risk more than 2% of your total account balance on a single trade. For instance, if you have a $10,000 trading account, 2% risk translates to a maximum potential loss of $200 on any given trade. This includes losses from stop-loss placement, commissions, and other trading costs. This rule is a cornerstone of risk management for professional traders employed by firms. By imposing such limits, firms ensure their traders can withstand periods of losses without depleting their accounts or jeopardizing their ability to trade. It's a simple yet effective safeguard against catastrophic drawdowns. While the 2% rule is a gold standard for many, retail traders have more flexibility. Depending on your experience, strategy, and risk tolerance, you might adjust this percentage. For example, a more conservative trader might risk just 1% or less per trade, prioritizing capital preservation. A more aggressive trader might risk 3% or slightly more, but this approach should be used with caution to avoid rapid drawdowns. The key is to find a balance that aligns with your trading goals and financial comfort zone. What's most important is consistency, sticking to your chosen risk percentage regardless of market conditions or emotional impulses. Trading is as much about managing probabilities as it is about strategy. To understand the importance of risk control, let's explore the chances of a losing streak using a simple 50-50 random walk trading method, a system with no edge, where every trade has an equal chance of being a win or a loss. Even in a system with a perfectly balanced 50-50 win-loss ratio, strings of losses are inevitable. Let's break it down. The chance of losing 2 trades in a row is 25%. The chance of losing 3 trades in a row is 12.5%. By the time you hit 5 consecutive losses, the odds drop to 3.125%. While these percentages might seem small, they're not impossible, especially over a large number of trades. And when losses pile up, so does the damage to your account. Without proper risk management, even a short losing streak can wipe out a significant portion of your capital, making recovery nearly impossible. This is where disciplined risk management becomes your lifeline. By limiting your risk to a small percentage of your account, such as 1 to 2% per trade, you ensure that even during a string of losses, your account remains intact. For example, with a 10K account and a 2% risk rule, 5 consecutive losses amount to just a 10% drawdown. Without a risk limit, risking 10% or more per trade could devastate your account in the same scenario. The takeaway? Limiting risk doesn't just protect your capital, it protects your ability to stay in the market and continue trading when your edge inevitably returns. While the 50-50 random walk demonstrates the importance of risk control, it's not the way to thrive in the markets. Success comes from stacking the odds in your favor. By combining technical analysis to identify high-probability trades with disciplined risk management, you can move beyond randomness and build a strategy that's not just about survival, it's about consistent growth.
Thank you for watching. To reinforce your understanding of this video, make sure to take the accompanying quiz pinned in the comment section below. And remember to like, comment, and subscribe for more trading content. Comment yes to get your free trading ebook.